Hello, in this presentation we will compare QuickBooks Online versus QuickBooks Desktop. Hello, in this presentation we will enter a loan payable adjusting entry. This will be the second adjusting entry, adjusting for the short-term and long-term portion of a loan within QuickBooks Online. We will have a comprehensive QuickBooks Online course soon, if not available yet. We also have a comprehensive Excel course which complements the QuickBooks courses and a QuickBooks Pro desktop version course you can find at the link below. Here we are in the QuickBooks Online dashboard. We will be continuing with the Get Great Guitars problem. We're going to be entering the short-term and long-term portion of a loan, talking this time about a loan that has both a short-term and long-term portion to it and has payments that includes monthly payments that we will need to break out. In order to do that, we're going to first go to the reports down here. So we're going to look at the reports on the left side. Within the reports, we want the balance sheet. We'll select the balance sheet, change the dates to 01/01/212/02/28/21, and we will run that report. So once again, the dates, if we scroll up here, it's going to be January 1st, 2021 to February 28th, 2021. We're going to be, what we have done so far is enter data for 2 months, and we're going to do the adjusting entries. We're going to make the financial statements correct, more correct on a accrual basis, in accordance with rules such as generally accepted accounting principles. One of those rules, of course, being to break out the short-term and long-term portion of liabilities. So if we scroll down to the liabilities here, then we see the liabilities of, down here, liabilities. We have the current portion of the liabilities and the long-term portion of liabilities. So what we have been doing in terms of the loans is putting everything that is a loan into one account called Loan Payable, and that account is in the long-term section. Last time we broke out one of those components of the Loan Payable in the long-term section to a current portion. The Loan Payable can be a bit tricky, and it can differ from company to company in how you really want to set up your system. Some people will want a different loan account for each loan that they have because they like to track a different account within their register. When we actually make the financial statements, however, we typically want to put the loans, group them all together, and then we still have to break them out into a short-term portion and a long-term portion. What we're doing here is we're going to put this the loan accounts all into this loan payable. So within the accounting department, we basically said, whenever you take out a loan, put the amount or the other side of it into the loan payable. So we've grouped all the loan payables here. We are then going to support that or back this number up by having the subsidiary ledger type accounts and the loans, the actual loans, where we can break out the amortization tables and figure out what numbers support this amount. How do we back this up? We look at those amortization schedules. So if we select this loan account, then we're going to see the activity. This is what has happened. There shouldn't be too much happening within a loan account note because we're not going to take out a whole lot of loans, and there's not going to be a whole lot of payments. They might be monthly payments on a loan, and that means we could have a monthly amount in terms of if we were looking at a year's worth of data. But we're not going to have things that are happening all the time to the loan payable. So it should be, even if we have a few loans out there, not too bad of a GL to take a look at. So if we go through here, we see that we started off with $22,000 loan. We increased the loan by $50,000 to $72,000. We made a payment, bringing that balance down. And then we had the $5,000, which is actually a different loan. This is another loan we took and we put it in the same loan payable account. So now this loan payable has two loans in it. One, which is the 22 and the 50, making the 72, and the $5,000. This $5,000, it turns out, is only a 6-month loan, and we adjusted for that. Actually, we put the loan in here and then we adjusted it out here. So we did an adjusting entry. This is the adjusting entry. This was us putting the loan in place. And we moved this loan to a short-term loan payable because it's all due within 1 year. So now what's left in this loan payable is just this 22 and the 50 that makes up that 72,000. We're going to say this is one big loan. We're going to look at the loan term for that 72,000. Then we have these payments of the 1,059 and the 1,063, and the question there is, are those payments accurate? Meaning, Did we break out the right portion of interest and principal to make these payments to this loan amount? If not, then we're going to have to adjust this loan balance to whatever the proper balance is. So there's two things that need to happen here. One, we need to say what's the short-term and long-term portion and break out that short-term portion. And two, we need to verify whether or not these payments here have correctly allocated between interest and principal. If they have not, then we're going to have to go back and adjust that allocation in terms of how much of this payment was interest, how much of it was principal. To do that, we'll look at the amortization table. So we're going to have to do a bit of Excel work. We'll actually put together an amortization schedule just because that makes it easier for us to read the amortization schedule. And oftentimes, when you take out a loan, they don't give you the amortization schedule. What they will give you is, say if this was like a car loan or a mortgage type loan, they're going to give you the loan amount. They're going to give you the payments that you're going to make. Now in this one, unlike the prior loan we looked at, this is going to be a more standard loan term for most individuals who may have to make payments. They make them monthly. There's an interest portion and there's a portion that reduces the principal amount. As opposed to the last loan we had, which is very common within business loan, which is we just get a dollar amount, $5,000 in that case, and we pay back the full thing plus interest at the end of the time period. So this one we're gonna take the loan of 72. That would be in the terms of the loan. 60 payments in the terms of the loan, and then the rate would be in the terms of the loan. What they might not give us though is the amortization table, which we'll create down here. They will typically give us the payment amount, but I'm going to recalculate it just to show you a nice little formula that we can use within Excel because it's a fairly common calculation that you could use. It's one of all the things that Excel does. This is one that it's worth memorizing or knowing that it's there. So what we're going to do is calculate what the payments are. Note that if you have any three of this information, you can figure out the last piece. You can figure out the last component in this case being payments. So the question here is going to be, if that's the loan amount, 60 payments, and this is the rate, then what is the payment amount going to be? We're going to figure that out. We'll use a formula. I'll use Excel's little formula calculator to make it a little bit nicer. This makes things a little bit easier. What we want is a payment formula. What's going to be the payment if I know all this stuff? And that should be the PMT. If I select that, it says calculate the payment for a loan based on constant payments and constant interest rate. That's the one we want. We'll select that. It gives us a little calculation box, and we're just going to put the information into the box as it has instructed us to do. So we have the rate, the interest rate per period. That's going to be this 5%. However, that 5% is for a year. So whenever you hear a rate, typically means per year. And we have 60 payments, and we're going to assume that's monthly payments. It says monthly payments. So per period would be that 5% yearly rate divided by 12 to make it a monthly rate. So this is the monthly rate. Notice it's really small monthly rate. That's why we don't work in monthly rates. We typically work in yearly rates and have to adjust them. So anytime you see an interest rate, it typically means a year unless expressed otherwise. And then we're going to say the number of payments will be 60 this time. And we're going to actually make an equal payment each time, just like we would on a mortgage or like a car payment or something like that. Present value, we're going to say that that is going to be the $72,000, the amount of the loan. We don't know the future value, or we don't need to use the future value. That's what it would be at the end of the loan, and so we're going to leave that blank. That's why it's not highlighted. It's not required for every type of calculation. So then we're just going to say OK and see what it says. There is the loan payment amount that we're going to be using. Now I like to see this in a positive number rather than a negative number. So to just flip the sign on a formula, any formula pretty much, you just double click on it. And then I'm going to put a negative right in front of the front of the formula. So I'm just going to put a negative. And that basically says, multiply the whole thing times -1. And so if we just say negative PMT, all that, enter, then it's going to flip the sign. So if you don't really have to do that, that calculation will be with you in most loans. What won't be there, however, is this payment schedule. So if we want to break out the interest and principal portion, we would have to go through this payment schedule in order to do that. So we looked at this briefly before. I'm going to do it a bit more quickly here to break this out. We're going to need this schedule, 1, to break out the short-term and long-term portion, and two, to figure out what the current and long-term portion of the loan is. So we're going to say the payments are all going to be the same. They're going to be this amount. I'm just going to say equals that amount. And then on the second cell, I'm going to say equals this. And that lets me copy it down. And what it does, it lets me copy it down. And then if I wanted to change it, I can just change one number. So then I'm going to put my cursor right on that little dot, auto fill it down, left click, drive it down, auto's driving it down. And then once we get to the bottom, Dr. Phil does the calculation for autofill. So the same number all the way down. Then we're going to calculate the interest. So the interest would be calculated as, we're going to take the 72,000 times 5%, 0.05, and then that would be for a year divided by 12. That'll be the interest amount. Now, if we did that the way we saw it in the calculation, it was 5% divided by 12 is the rate, very small rate for a monthly rate, times 72,000, same 300. So let's do that here. We're going to say this equals, we're then going to point to the 72,000 up top. So we got the 72,000, and we're going to multiply that times the 5%, which is pointing and clicking. That's J2 times J4. And then we're going to divide that by 12. And that'll give us our 300. So that's going to be the amount of interest. If this is our payment, and that's the interest, then we can calculate the reduction of principal, which will be the difference between the two. So the difference is going to be this amount right there, minus the interest portion of 300, remaining the principal will go down by that amount. So then we're going to say, well, what's the new principal amount after the first payment then? Well, the old principal amount was 72,000 minus what it's going to go down by, 1,059. So I'm going to do that one or two more times, and then we'll just copy and paste this down, and we'll see what are we going to do with this. So now we've got the interest again. Note the interest will change because we have a new principal amount. So we're going to say this equals the new principal amount, not that amount up there, times the same interest rate, 5%, divided by 12, because that percent is a yearly percent, and we want a monthly percent, and tab. So it's a little bit smaller, a little bit less, and therefore if the same payment is there and we have a smaller interest portion of it, then if we subtract these two out, this minus that, the payment minus the interest, means that the principal went up a bit, meaning the principal reduction, I should say, went up a bit, meaning the principal itself, the amount that we actually owe after the second payment, will go down. So let's do that. We're going to say it's the 70,941 minus that principal reduction portion gives us the new amount. Let's do this one more time, and then we'll just copy this down. So now we're going to say this equals the new principal times the interest rate, 5%, divided by 12. And then we're going to say that's the new interest. If we subtract out the payment minus the interest, we're going to say this equals the payment minus the interest. And that gives us the new principal reduction. Then we're going to say the principal then is going to be the old principal minus the new principal reduction, gives us our new principal amount. Now we're going to try to copy this down. It's going to have a problem with it, and then we'll fix it. So we'll highlight these three cells. We're going to put our cursor right on that autofill box and left click and drag down one cell. And we see there's something really bad happen here, or something incorrect, let's just say. Well, if we double click on that, then this number did what we wanted. We wanted to take that number, but not multiply it times that. We want to multiply it times the 5%, meaning this number shifted down as we wanted to, but this number we wanted to stay at the 5%. So what I'm going to do is I'm going to delete that, and we need to fix this cell to make it so I can copy it down. So if we double click on that 5%, it's going to move down if I copy this formula down. Don't want that to happen. That is cell J4. So in the formula on J4, we're going to put a $ in front of the J, $ in front of the 4. That's just a formula. That's just a code, in essence, in Excel to say, hey, don't move that cell down. When I copy it down, don't move that cell. And so we're going to say enter, and then we'll test this out again. We'll highlight these three, and I'm going to autofill it down. There's the autofill box, autofill it down, and that looks about right. So now we're going to copy it all the way down to the 60 payments. I'm going to put my cursor on autofill, and auto's going to drive it all the way down, and Dr. Phil's going to do the calculation. So we're going to autofill all the way down here. and until we get to 60 payments. Once we let go, this should be 0 at that end of that. So that's it. So that means that it's basically we've done this correctly. So now we have an amortization table, and we know the payments are all the same, but notice way down here the interest portion is way almost nothing, and it's almost all principal that we're paying, and that brings us to the 0 portion, as opposed to up here with the same payment amount, a lot more interest, a lot less reduction in principal. And that's because, of course, the balance is going down as we go. So what's the point of this? Well, now we know that where are we at this point in time? We've made a couple payments. If we look at our Excel here, or our QuickBooks file, back to the QuickBooks file, we've made these 2 payments. So what we're saying is we're looking at this after the second payment, and we're trying to determine how much we owe at that point in time, and how much is short-term versus long-term. So first, are these payments correct? Oftentimes they're not, because the person making the payment may not have an amortization schedule. So they may put the entire payment here, or they may put the entire payment to interest expense. If this was not correct, which ours looks correct. See, this was broken out to the 1059 and the 1063. So that's 1059, 1063. If we look at that payment, if we click on that and look at the payment, it was broken out. The actual payment was for $1,359, which is the $1,359, and it was broken out between interest and principal. So so in this case, we did it right during the payment portion. So I closed that back out. We did it right during the payment portion, but it's common to set up a system where you basically tell the accounting department, or we do it ourselves, and we say, hey, I'm just going to write the whole amount of the payment to the principal reduction, and then adjust it at the end of the time period, or have my CPA or my adjusting tax preparer help me fix the loan amount at the end by adjusting for the amount that should be interest. So that's one thing we need to do. And then the next thing we need to do is recognize the fact that whatever the balance is, 59,878, if we go back to the Excel, it should be 59,878. What's the current portion of that balance that we need to break out? And that's where we are now. So we're saying that we've done these two payments have happened. And this then is the balance that we're dealing with. So this is the balance we have at this point in time. And that's correct. That's what's in our books here. So it looks like the payments have been done correctly. That's our ending balance. So now our only question is, how are we going to break out between short-term and long-term portion? So we know that we're going to make 12 payments. So you would think I could just add this up: 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. I think that's 12. And that would add up to 14,946. Or in other words, if we just took this 1,359 times 12, that's how much we're actually going to pay in the next 12 months. So you would think that's the current portion. It's 12 months. That's what we're going to pay. However, this payment includes the interest and principal. And remember that this interest portion hasn't happened. We haven't incurred it yet. It's kind of like paying rent before we live. We're not going to record a liability for something that we haven't incurred yet. It'd be like recording the fact that we're going to use the office building in the future, so we should record the liability now for the future use of the building. We know we're going to use this money in the future, and so we should record a liability now for the future use. No, we're not going to record a liability now, because it's a liability means that we have used something and incurred it. So what we need to do then is break out. This is what we're actually going to pay, but we only owe at this point in time the principal portion. We only owe this amount. So we need to just break out the principal. That's why you need the amortization schedule. So we need to take 12 payments of principal, this plus this plus this, and they're not all the same, unlike the payment, which makes this a little bit more difficult to do. So we're going to say 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Those are the current portion. That's what we owe now, which we will be paying within the next 12 months. If we sum those up, then I'm just summing up the current portion. I'm just equals the sum of those yellow items. We're just adding those up. That's the current portion. And that means we'll be left with this. This is basically the long-term portion. So as of this point in time, if we subtract this out, the 69,879 minus this amount, we'll be left with this amount. That's going to be the long-term portion. So this is our total amount. This here is current. And this then, well, actually, let's do this up here. This is current. And this is long term. And then this is the total, which is the sum of this plus this. So there's basically our breakout. Here's where we're at. Here's the 12 months current portion. Here's where we'll be at the end, the long-term portion. That's what we'll be at. This will be the total that we'll be at the end of the next 12 months. And it'll be what's due after 12 months as of this point in time. If we add up the current and long-term, we get to the total amount that's owed at this point. So what do we need to do? There's 69,879 in the long-term portion. We need to break out 13,109 of it to the current portion. So we're going to do that. We're going to go back over here. Typically to do that, we do that with a journal entry. So I'll just show you that, and then we'll actually use a register to do this. So we're going to select the plus item. The journal entry is in here. Here's the journal entry. And typically we would have to increase the loan payable current portion with a credit for the 13,109 and debit or decrease the long-term loan payable for the same amount, and that would do it. We're going to try to use the registers here just to practice using the registers, just to show that QuickBooks, you can do stuff with the registers and use less debits and credits. If you know debits and credits, this would be the easy way to do it. If you don't know debits and credits, it's really good. I mean, it's really, whether you know them or not, if you know debits and credits, it's really good to try to see how it would work without debits and credits, see other ways that you can input it, and you can kind of figure out how to set up systems to help work with people that might want to work in a different format, that don't want to see the debits and credits, even though QuickBooks will be using debits and credits. And we'll see that. We'll use a register, and QuickBooks will still make a journal entry. So we're going to go back over here, and we're going to go to the accounting, and we're going to go to the chart of accounts, and we're going to look for either the short-term or long-term portion. We typically deal with this chart of accounts when we deal with cash up top, right? Cash. But any account that's a balance sheet account, QuickBooks makes a chart of accounts for. So we're going to scroll down. It's in order by type. So these are assets and then liabilities. And then I'm going to go to the long-term liabilities. So that's the one that has the 69,878. And remember, that matches what's on our table right here, 69,878. So we're going to select that item and select the register. And we're going to have to decrease it. So I'm going to say there's only two options here. There's a journal entry. We're going to make a journal entry, but we're going to use the register to do it so that we can try to eliminate debits and credits. So we're going to say 02/28/21 is the date. Always at the end of the period we're working on is the adjusting type journal entries. No payee. I'm going to just call it an adjusting entry. For the memo, we're going to decrease it by this yellow portion, the current portion, 13,109. So we're going to decrease it by 13,109, and then the other side is going to go to the loan payable long-term portion. We could select the drop down to find it, and or type in loan payable, and then we want the current portion, and it should say up here in the account type that it's the current liability. So current liability, and that's going to be it. We're going to save that. And then once we do, we see the balance is 56 something over here. We can't really see the whole thing. 56,769. That is this balance. That's where we are at the end. So that's what we want. That looks good. Let's go to the current portion and check that out first in the register, then in the financials. We're going to go back here. We're going to check the loan payable for the current portion. Scrolling up, here's the current portion. It's got this 18,109 in it. If we select that item and scroll over, we've got 18,109. Here's the 13,109. So here's the 13,109. That's what we want. The other portion, of course, if I unhide this, is the 5,000. So the 5,000 plus the 13,109 is the 18,109, or should be. Yeah, that sounds right. Yeah, that's right. Let's take a look at that on the financial statements as well. So we'll go to the financial statements. We're going to go to the reports on the left side. We're going to go to the balance sheet. We're going to change the dates to 01/01/21 to 02/28/21, and That's January 1st, 2021 to February 28th, 2021. Run that report. So then we're going to scroll down. We're looking at the liabilities section down here. We see the liabilities section down here. Here's the current portion. Here's the long-term portion. So note we have two loans in our case grouped together, but we have to still break them out. So we're gonna put all the loans and group together, but then we still have to break them out between short-term and long-term, and we're gonna have to back that up in some way. We're backing that up with our schedules over here. Here's a 5,000 loan. It's all short-term because it's all due in 6 months. Here's the other loan it was for 72,000. We now owe 69,878 on it. Therefore, the current portion is this amount plus the 5, or the 18,901. That is going to be the current portion here. If we click on that, we see the activity. There's the 5,000 we moved up here. Here's the 13,109. If we select that item, then here is our journal entry. And note, once again, it goes to a journal entry even though we put it into the register. So it's crediting the current portion, increasing the current portion of a liability, and debiting the loan payable long-term portion to decrease it. If we close that back out, that's the current portion. Scrolling back up, going back to the report, back to the balance sheet. If we then go down to the long-term portion, click on that. It's a bit more complex of a looking thing here because we have the payments in here as well. So we had this is the first loan minus these two payments. That would give us the loan balance in that larger loan. And then we had this other loan that we put in place here that we put into this account. Then we took this loan out and that account, and we removed the short-term portion of the $72,000 loan. All of that, at the end of the day, if we check off all of that and try to figure all that out, we're going to say, well, what should be in there? It's only the long-term portion, that's 69,878. So if we go in here, it should be left with, let me check that. It should be left with, I was wrong on that, sorry. It should be left with 56,770. So if we go back here, 56,769, it's $1 different. That's rounding. So that's going to be this balance. And again, you can go through here and kind of check these off in order to do that. You got to say, well, here's the 72. Here's the two payments. They were correct. Because they're only the principal portion. We moved this one out, so I'd have to cross that one out, so it's gone. And if we figure that out, we say, okay, that should be left. That's what is at the ending balance after we have the current portion. So here's the current portion. Here's the long term. And you can kind of work that out. So those can be a little bit tricky if you got a lot of loans. I'm going to go back to the bank statement, and it's also a little bit tricky to work through the accounting process in terms of the adjusting process versus the normal day-to-day input. Meaning, if you go back to the normal day-to-day input, and it's a different department, they might be saying, well, what did you do to my loans payable? Now I got this 2 loans payable. What do you want me to do going forward? You might want to reverse that. You could do the reversing entry and just have one loan payable account so that you only have it all back in this one account and then just adjust it each month. Or you might just tell your normal accounting department, hey, just keep posting it the way you're posting it into the loan payable, and we'll just keep adjusting the current portion out at the end of each month. Hello. In this presentation, we will break out the short-term portion of a loan payable within QuickBooks Pro 2018. Last time we looked at a loan payable where we had to reclassify it from a long-term to a short-term loan payable. This time we will take a loan payable that has a short-term and a long-term portion, look at the amortization schedule, break out the short-term portion, give some reasoning as to why to do that, how to do that in terms of the amortization schedule, and as well as how to technically do it in the QuickBooks software system. If you've been continuing along with us, we will be working with the Get Great Guitars problem. If not, that is okay. We will be doing adjusting entries within QuickBooks, breaking out the short-term and long-term portion of a loan. If you have the backup file to this point, you can restore it by going to File, Open, and restore the backup file. If not, that's okay. If we do have the Open Windows tab open, in order to open the Open Windows tab, go to View, Open Windows List. We only have the Home tab open. To have the Home tab open, we want to go to Company and Home tab. What we're going to do is break out current and long-term portions of a loan. In order to do that, we are first going to look at the report for the balance sheet. So we'll go to Reports up top, scroll down to Company and Financial, scroll down to the Balance Sheet Standard. And we're going to change the dates up top in the Customize Reports, and we're going to have the range be 01/01/21, January 1st, 2021 to 02/28/21. This will be the time frame that our problem is working in, and then we're going to select OK. And here is our information. If we scroll down to the liabilities, we see last time we broke out the current portion of one of our loans being a short-term loan, and we had to pull the whole amount out of where the loan payable account was set up to this short-term loan payable. This time, we're going to take the rest of this long-term loan payable, and break it out between a short-term and long-term portion based on how much of the principal payments are going to be due within a 12-month period. So if we double-click on this item, we see the loan was 22 and then 50. The loan was at 72,000, and then during the year we made these two payments on the loan in accordance with the amortization table, decreasing these amounts in accordance with the amortization table. What we will do now is look at this balance, look at the amortization table, and see how much of it is current versus long term. This is something required if we were to issue the reports to externally typically, because it would be generally accepted accounting principles to have the short-term and long-term payments. It's also really useful when we're looking at the financial statements to know how much is going to be due currently and compare that to our current assets, whether we have enough cash to pay for those current liabilities. When we do this in practice too, remember that we are going to put everything into a current portion and a long-term portion, one grouping of accounts. If we have a lot of loans, more than one or two loans, we might want to actually break out each individual account that is a loan account, and that might make it easier to track. However, within the reporting of the financial statements, we typically just need that current portion breakout and the long-term portion breakout. So we're going to have those two accounts here, a current portion and a long-term portion, and break out whatever loans. We only have two loans within those two current and long-term portions. If you have a lot of loans, you might want to put one separate account for each loan and then a separate short-term and a separate long-term portion. There's a couple different ways you can format this out. Clearly, if we're making loan payments, however, that have an interest and principal portion, it's not typically efficient for us to break out the short-term and long-term portion at each payment date, meaning each payment we make, it might not be efficient for us to break out the long-term and short-term portion because it'll differ as we go. So what we want to do is do these adjusting entries periodically at a point in time when it makes sense, when we're really analyzing the financial statements or distributing financial statements to external users. That's when we want to make these adjusting entries and make sure they have been input. Also note that we are putting these entries in net of interest. So if you double click on these entries, we can see that they're being put in according to the amortization table, meaning they have an interest portion and a loan payable portion. We could also even set up a system in which we do the interest portion at the end of the time period as part of the adjusting journal entry. We'll talk more about that in a bit. What we'll do now is just break out the long-term and short-term portion, first looking at our amortization table and getting an idea of what that is and how to make sense of it. So I'm going to close this back out. We're going to take a look at the amortization table. Here is the amortization table, and so we have the loan amount, the payments, 60, so it's going to be 5 years, and then we have the rate, 5%, and the payment. This loan is going to be set up as kind of, we might be familiar with like a mortgage type of loan, or typically kind of payments for auto payments or something like for financing a car or something like that, where we have both a principal and interest portion and the payment is constant. So the payment remains constant. However, the application between interest and principals varies as the number of payments go. As the principal amount declines, the amount allocated to interest of the same payment goes down. The amount allocated to principal goes up. So that means that it's going to go down, but not at the principal portion will go down with each payment, but not at a constant rate until the end of the 60 payment where we will be at 0. When breaking out the current portion and long-term portion of a loan like this, it's a little bit confusing because we know that we have a loan balance here. If we look at our activity, back to QuickBooks, we made 2 payments on this loan. So we made payment 1 and payment 2. So we are at the balance after that second payment. If we go back to the amortization table, we should be at the balance right here. So we're going to go ahead and highlight that. I'm going to highlight that, and that's where our principal balance is. This $69,878 back to QuickBooks is equivalent to this $69,878 right there, and it's our ending balance $69,878. Now, of that amount, we need to determine, back to the amortization schedule, we need to determine how much is current and how much is long-term. In order to do that, we need the amortization schedule. We cannot just take the payments and say, well, 12 months of it is current. Current means, by definition, what we owe in the next 12 months. And the logical thing to do then would be to say, well, we have payments of that times 12 would give us 16,305 would be the current portion, and then the rest would be long-term. That would be a reasonable assumption. However, it's not correct because this 1359 includes the interest portion, which has not yet happened. So that would be like recording the interest expense on a rental apartment or a rental office before we actually lived in it, knowing that we're going to pay rent in the future, and therefore recording the fact that we have that current liability now, even though we haven't lived in it yet. So that's the same kind of thing is happening. We can't include these interest payments in the current portion because we haven't used the money to help us generate revenue, and therefore we don't technically owe it yet. So what we have to do is find just the current portion of the principal payments, and so we need this amortization schedule to do that. So the payments that are going to be due in the next year are going to be this one: 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. There's a year. If we highlight that, that's going to be our year's worth of amortization portion of our payments. So here's our payments each time. The interest changes each time, therefore the amount of principal changes each time. And so what we're going to do is we're going to say the current portion is going to be all of these principal portions for the next 12 months. Those are going to be the current portion. And if we then say that this is where we're at, let's bring this. I'm going to bring this up to here. All this is the sum of the yellow items, the current portion. So we're going to say that if this is the total loan minus the current portion, this will be the long-term portion. In other words, after we make 12 months of payments, we make all these payments with the interest and then the principal going down by this column, we will be at 56,770, 56,770. So that's our ending, that's our long-term portion. So in essence, our journal entry will be then, for this 13,109, decreasing the long-term loan payable and increasing the short-term portion, decreasing the long-term portion to 56,770 and recording the short-term portion at 13,109. That's going to be our adjusting entry. So let's go back to, well, I'll keep this here. Let's go back to QuickBooks and make that adjusting entry. We're going to go QuickBooks. Now, in order to do that, let's close this back out and go back to the balance sheet. So the balance sheet is currently open. Typically, the normal way to do that is to go to banking and go to, go to company and go to adjusting journal entries, make adjusting journal entries. But we would need to know debits and credits in order to do that. So we'd have to debit the long-term note and credit. Debit the short-term note payable and credit the long-term note payable. If we want to do that without debits and credits, we could use the registers, and that's what we'll work with here. In order to use the registers, we can just go to the banking and we can scroll down to use registers. So we'll actually be able to enter these adjusting entries without knowing debits and credits, and we'll just say use register. And like the checking account, every account has a register. So we're going to scroll down to the register for loan payable. We'll use the current portion. Make sure you know which one you're in, current versus long term. And we're going to go to the current side and say OK. And we know that the current portion needs to increase by the amount that's going into the current portion. So we're going to have the date at the end of the time period, 2/28, and we're going to increase it by the current portion according to our amortization table, which is 13,109. So we're just going to put in the current side, 13,109, and then the other account is going to be the long-term side. So the long-term loan payable, if we scroll up, we got loan payable current, and then just loan payable long-term is the account type. That's the one. So by doing this, we're going to increase the current account we are in, the register we're in, long-term loan payable current, and then it's going to decrease the other account we're assigning to, which is the loan payable. So we're going to select enter. And then when we go to the balance sheet, make sure you select enter, by the way, or else it won't record that. And then we're going to go to the balance sheet, and we can see that the current portion now at 19,109. If we double click on that, we see the 13,109 here. Double clicking on that, there's that amount. So closing this back out, the current portion of our loan payable now includes two loans. One, the 13,109, which is the current portion of our long-term loan, and then the 5,000, which is just a current loan, and that matches what we have here, 13,109 in our amortization table, and the other loan, of course, the entire principal amount of 5,000 there as well. Back to this, close in that. If we close this back out and then go to the long-term portion, here's the long-term portion, 56,756. Double clicking on that, we see our activity. There's the adjusting entry we just made. Double clicking on that, there's the amount. If we close this back out, we say there's that 13,109. That matches this amount here, our adjustment. What's left? 56,769, which is our long-term portion we see here, or we see it after the 12 months of payment. After we make these 12 payments, that will be the balance a year from now, the full balance a year from now. In other words, that's why it's the short term, that's why it's the long-term portion, because it's where we will be at after a year of the short-term payments of 13,109.